Welcome to Block Time, a podcast by Riot Platforms. Today we're joined with our VP of Capital Markets, Phil McPherson. Phil, welcome.
Hey, good morning. Thanks for having me.
Thanks for coming in. What brings you to Austin today?
Yeah, so I've been on the road with a bunch of investor conferences, and Permissionless was this week in Austin. And so usually around industry events, there's a lot of people that would like to see our facility in Rockdale, about an hour here from Austin. And so I had a group of investors and one of our covering analysts come out for dinner, and then took them out and did a tour and showed them the world's largest Bitcoin mining facility. So I love saying that.
Yeah. And Gabe takes great pictures of the facility. So don't take this the wrong way, Gabe, but there's nothing better than seeing it in person.
It's awesome. It's and I think for people that are new in the industry, it makes Bitcoin seem more real. You know, like they see the resources, they see the money, they see the people, and they're just amazed. So
it goes from being like a virtual currency to an actual commodity that is being mined.
Yeah, it's these guys, they're some of the smartest people in finance, right? And a lot of smart finance people are so curious about Bitcoin, and when they get to see 20,000 machines in a rack in our air-cooled building, and it's so loud you can't hear each other talk. And then you go into the immersion building, it's so quiet you can hear a pin drop. It just kind of blows people's minds away. So it was awesome. The group that we had probably manages close to $50 billion of assets.
Wow!
So
all right.
Yeah. So it's like wow.
Yeah. Institutional investors. Did the ETF come up at all? I know that's been in the news quite a bit.
The ETF came up, sentiment came up. It's kind of wild. I think you commented it the other day on Twitter that like sentiment today at 25, 26,000 feels worse than when we were at 16,000. And that's kind of I think where the investors were yesterday, is they're kind of wondering, okay, is now the time to get in? Is it going to go lower? The ETF, I think everybody is really excited about. One thing that I was talking to an analyst about that I hadn't thought of is, it's not just the amount of money that these companies manage that are doing the ETFs, but it's their marketing budgets. Yeah. And so you think about the amount of money they're going to spend marketing a new product and bringing it, to the masses, and that's what kind of gets me excited. Most asset managers don't want you to take money out of their accounts that they manage and go buy Bitcoin because they don't get paid on it.
Yeah.
Right. So if they can now do it under their platform and charge you a point, then they're all for it, right? So I think it's going to be one of these, I call it kind of like a Richter scale. Like it's going to start kind of slow, but then it's going to, jump really fast, because a lot of people are going to all of a sudden be meeting with their financial advisor for their quarterly update, and they're going to go, maybe you should put 1% into Bitcoin or whatever that allocation is. And so I think the approval of the ETF is going to be one of these tsunamis that we look back on as a huge part of the Bitcoin story.
Yeah, I mean, on the marketing, even before launching, you've got BlackRock's Larry Fink on national television saying, "Hey, Bitcoin's like digital gold."
Yeah.
So they're already, kind of shifting their positioning to a more constructive view on the asset.
It's great, and it brings a lot of legitimacy, I think, to the space. I was at this conference, and I still meet people that don't know what Bitcoin is. That's what gets me excited, right? Like I was just in like having coffee in like a general area at this conference in New York, and some lady's like, "What do you do?" And I said, "Bitcoin mining." And she's like, "Oh, and we start getting into it, and they have no idea what it is. And then she's like, "Well, aren't I too late?"
Yeah.
And I said to her, "No, like we're so early." And one of the analogies I've been using lately is, think about how long it took our moms to stop writing checks at the grocery store. Right? Like, remember your mom pulling out a checkbook and writing checks, and now a credit card is like, you don't even think about it, right?
Yeah.
But back then it was like, oh, I don't know if I can trust this credit card. So, we're early, 14 years in. It'll be fun to watch the next decade or two or three, how it evolves.
Yeah, absolutely. So I think that the ETF is a big catalyst. The other one is the halving. Were there conversations around that at these investment conferences, or is that too in the weeds?
So some people know about the halving and they want to focus on it, a lot. Some people don't know what the halving is. So, when I'm talking to investors, it's from the person that, I had a person once that called me about our stock and I was like, well, Bitcoin's up or Bitcoin's down. And they're like, what's Bitcoin? So that's the base level. And then you have people that are like, well, when the halving occurs, this is going to happen. And like they go down the wormhole, right? So what we did recently in our new investor deck is put a page specifically on the halving to talk about how Riot's position going into the halving. And so I think people appreciate that. We kind of have three pillars that we think about. One is our machine efficiency, which is, one of the best in the sector, and it's getting better as we develop Corsicana, which is our next site. We're one of the lowest cost producers. And so, my background, I came into Riot from the energy side. And when I was an energy analyst covering, public companies, the number one thing that you could do to differentiate yourself in a commodity business was be the low cost producer.
Right.
Because if you're the lowest cost producer, you then get a higher multiple, which means you can raise more money, which means you can grow faster, which means you get a higher multiple. And it just kind of, snowballs. And so for the first half of this year, we're just below $9,000 per Bitcoin. The industry average is at 14,000. So as you go into the halving, that all doubles, right?
Yeah, and that doubling, I think that's not intuitive for folks, like especially within Bitcoin. It wasn't until I started talking with you that I heard this kind of way of looking at the world of, okay, that yes, the block reward gets cut in half, but another way to look at it is the cost to produce one Bitcoin is multiplied by 2.
Right. And I started looking at Bitcoin in 2017 when I was running a small oil and gas company in California. And we were looking at it to mine Bitcoin with stranded gas. So I didn't even really know what Bitcoin was. I kind of was still in that I'm a finance guy and this is a, not real kind of thing. But I was looking for a way to maximize a resource that we had, which was basically free natural gas. And so I went down that wormhole to figure out how much it would cost to make a Bitcoin. And this was in 2017 when Bitcoin was about $3,000. And it was going to cost $3,000 to do one. I was like, I don't need this headache. I'm already dealing with enough with oil and gas, right? Then it went to 21,000, and I was like, oh shit, did I miss something?
Yeah, right.
And so we went down the wormhole again, and I actually learned more about Bitcoin on the second phase. I learned about the 21 million and the scarcity proposition. I didn't even know that when I first looked at it, right? I just thought it was like all other stocks and all fiat, like it's just going to get diluted, right? And so that's how it kind of started from figuring out the cost. And in the oil and gas business or in most commodities, you're always trying to figure out what the marginal cost of production is, because that's going to determine where supply and demand kind of, meet in the middle. And you're going to have bullish markets and bearish markets, but that benchmark is going to kind of be there. And so now being at Riot almost 3 years now, it'll be 3 years next year, the cost to mine Bitcoin, I think, dictates a lot of what's going on in the capital markets, people's ability to add hash rate, which affects the global network, which affects your production costs. And so it's the thesis about being a low-cost producer is, I think, the way to think about it. And but yeah, on the point of the cost side, when the reward gets cut in half, it still takes just as much electricity to make those Bitcoin and mine those Bitcoin. And so your costs double.
So, when you're talking with investors and they ask, hey, look, in theory, efficient market, right? Shouldn't everybody's cost be the same? Like, how does Riot differentiate itself to have that lower cost?
Sure. So the first one I was talking about was the machine efficiency. So we have, one of the latest and greatest, machine fleets, if you will, almost 100,000 machines. And you judge that fleet by your terahash per second, or your joules per second, excuse me. So as new machines come in, the older machines become less productive, and that affects your cost to mine Bitcoin. The second one, which I think is actually the bigger factor than just the machine efficiency, is your cost of power. And so being located here in Texas, we're able to utilize a lot of power at very low prices because the grid is so big. The Texas grid is the biggest in the United States. The renewable portion of it is bigger than all of California's grid. When I tell investors that, they're like, wait a minute, that can't be right. I'm like, no, Texas has more renewables than California has of everything. And it just shows you the size of Texas, the size of that, industrial economy. And so what's great about, for us, is this renewable, transition, as they try to call it in the press, right? Going from fossil fuels to wind and solar, it has positives and negatives, right? The negatives that people I think are starting to realize is that there's intermittency. And so when the wind doesn't blow and the sun doesn't shine, power prices, are volatile. And for Bitcoin miner, that's the perfect recipe because we can go out and lock in low cost power prices. And then when those spikes in demand and spikes in supply going down, we get these huge spikes in energy prices. And since Bitcoin mining isn't mission critical, like we're not a hospital, people aren't on respirators, so we can idle our machines and then we can take that power and provide it back to the grid so that we don't have blackouts here in Texas. And we do get paid to do that. We get power credits and we get paid for ancillary services. And so that power strategy is what's been the differentiator for Riot and allowed us to have the lowest cost of production. If you are in Canada, you have, the government tells you what the price is, right? If you're in Georgia, you're in a fixed grid where they tell you basically what the price is, right? You can't sell that power back. So Texas for us is, I think, the differentiator in our power strategy.
Yeah, and I think that along those lines, what a lot of people miss is that what we do has a stabilizing effect on the grid and helps shave those peaks so that we can actually, by selling power, try to push down the price, essentially bring supply onto the market. And then on the shoulders, at night, there's times when electricity prices are negative because renewables are overproducing, and Bitcoin miners help push that floor up so that ultimately we get more power capacity here in Texas, and that benefits the grid.
Yeah, I mean, we in our deck we have a couple statistics in there, but in just the last 6 years, the grid has gone from 80,000 megawatts of installed capacity, and next year it's supposed to hit 120,000. So that growth is more than the state of California's entire grid, and it's all being driven by wind and solar. And I always use this example with wind because I think people can relate to this. You think about the jet stream coming from California, right? It always takes less time to fly to New York than it does to fly back to California, right? And so all of that wind comes from the Pacific Ocean. It filters through the Rocky Mountains, and then the Gulf of Mexico is a low pressure, system. And so it pulls that wind right down through the panhandle. And when you drive out into West Texas, there's windmills as far as the eyes can see. And that's the phenomenon of that wind. But to your point, it blows the strongest at night, right? And so what happens is if you just think about your everyday life, right? When you get up in the morning, you use a lot of power, right? You're making breakfast, you got the TV on, maybe you try to sneak in a load of laundry or whatever. Then you go to work and your power consumption goes almost to zero. And then when you get back, from work, you start cooking dinner, you got your air conditioner on, you got your flat screen TVs on. I just read something, for the EV market, you're now plugging your car in, right? So I need to find out how many EVs are being sold in Texas because they're saying that could be a big drain on the grid. And so what happens is right when everybody gets home from work, the sun sets and there goes all that, supply, right? And at the same time, demand jumps. And so that's what they call in the solar industry, the duck curve, which is because the power demand and the supply look like a duck. It's like the back of the duck and then the neck of the duck, right? The supply is up here, then it comes down, and then demand spikes. And so, it's pretty wild. Like I was telling somebody yesterday that I went from traditional energy to digital energy, and it really is an energy play, and it's a core piece of what we're doing at Riot.
Yeah, this past summer, just looking at the price of electricity every day, it's pretty clear that there's a time where when the sun is setting and the wind hasn't picked up yet, it picks up later in the evening, but it's still 100 degrees outside, even without the sun. And so people still have their AC running. That's when the grid really needs to have more supply there. And that's where, Bitcoin miners are able to turn off.
Yeah, it's a wild phenomenon. And I think it's probably only going to get worse, to be honest with you, because unfortunately they're phasing out a lot of natural gas generators, which are the most reliable. Texas is has a ton of natural resources. There's more natural gas in Texas than they know what to do with. The old joke in the oil and gas business is you always drill for oil and you find natural gas. And so the Permian which is just a powerhouse, from production and growth and all that. When you're drilling an oil well, you always get associated gas with it. And what typically happens geologically in basins is as you drill more wells, the oil to gas ratio usually increases, meaning you get less oil per well and you get more natural gas per well. And I think that phenomenon is going to continue for the next decade or more. And so I think Texas is going to have lower for longer power prices because that cheap natural gas will kind of set the floor. And then the intermittency of renewables, which is growing, will continue to have this volatility. And so it'll be interesting to see where things go. The other big problem you have here in Texas is all of that power is in the west side and all the people live on the east side. And you can't get the electricity from the west side to the east side because there's not enough transmission. So we'll see if they try to attack that problem next. But building transmission lines take years and years, and you'll get some NIMBYism on that, and
and it's expensive too.
It is.
It's a big capital investment. So the price of oil has been elevated, but the price of natural gas has really come down quite a bit over the past 18 months.
Yeah, I mean, and I think it's back to that, like when you're drilling, you're really drilling for the oil because it's so much more valuable and it's easier to transport. So like when you could have a stranded asset of oil and you drill it, you produce it into the tanks, you put it in a truck and you sell it to the refiner. That natural gas, if you're not near a pipeline, you can't use it. And now with the flaring regulations that they've enacted, you can't even flare it, right? And so we run into a lot of people that are using that flared gas or what was flared gas to mine Bitcoin. Riot really hasn't gone down that route. I think it's an interesting play. It's a little smaller on scale. You can't ramp up the way that we have, from, just a couple of years ago, we were at 3 exahash. Now we're at 10, right? I mean, going from 100 megawatts to, 400 or 500 megawatts, right? But I think it's a good solution. The higher the price of the Bitcoin goes, the more you'll see that because that gas needs to be used. But again, when I looked at it in 2017, there's a lot that goes on behind the scenes. You have to buy a natural gas generator. They're very finicky. They cost a lot of money. You got to maintain them. You have to have your containerized systems with your machines there. You got to, sometimes you're 5-6 hours out in the middle of nowhere. You got to get people to go out there and do it. So it'll be interesting to see how that market kind of happens. There's some pretty cool private companies doing it. There's been some rumors that, with carbon capture and the legislation and carbon credits, as they become more valuable, that some of these private companies could be, takeover candidates for companies trying to get to that net zero. And I don't know if you saw the other day, Apple announced that they're going to be, net zero. But what most people didn't see is they're buying credits from. Did you see who they're buying it from?
Tell me.
Oxy.
What is Oxy?
So Occidental Petroleum is one of the top 5 oil and gas companies in the world. And through the Investment Reduction Act, the IRA that the administration has put through, there is a lot of money for carbon capture and sequestration, which is very hard to say. And what CCS, yeah. And what that basically is they can capture carbon and they can pump it into the ground and take it out of the atmosphere. Or like in Oxy's case, if you have a large refiner, when they're refining oil, they're emitting CO2. So they capture that CO2 as it comes out of the smokestack, and then they bury it underground. Well, the government is going to pay them to do that. Mm-hmm. So they're going to reward them with free carbon credits, and then Oxy can turn around and sell those credits in the open market. So Apple and Oxy are now simpatico. Which just blows my mind, right? I mean, it's like it's the whole carbon credit thing. I mean, it depends which side of the fence you are on global warming.
I think though that even in particular, if you are concerned about climate change and you're trying to reduce carbon emissions, the effectiveness of carbon credits you should be concerned about. And
who's paying for it?
Who's paying for it? And I've seen journalism, reports about carbon credits that are basically, hey, pay us to not cut down this forest. And then they do it over and over, right?
Yep.
Because you can make that deal many times.
Or you can get paid to plant a forest too. I mean, I looked at like teak farming, and you could do it like there's a certain band on the equator you can do it, and then if you plant teak trees, you get rewarded carbon credits, and then you can go sell them. But at the end of the day, somebody's got to pay for it, and unfortunately, it's the consumer, right? So how much of the recent price raise on the iPhone 15 is to pay for those carbon credits, right? I mean, somebody's paying for it, and people don't think about that. Like in California, we have really high gasoline prices, but we also have the highest taxes on our gasoline. So every gallon we're paying like $1.50 in taxes. Where's that money going? What's it being used for, right? And I think getting back to Bitcoin, that's one of the things that really got me into Bitcoin was just kind of the anger with what the government has been doing with our money and the spending problem and the taxation, and it's out of control. I mean, and everything you do in your life, there's some kind of tax or something you're paying that you don't think about it. And when I was in the oil and gas space, people would always blame us for high gas prices. And it's like, do you understand Econ 101, supply and demand? Like, if you don't give us permits to drill, there's less supply, and then you tax it. And so, but the Oxy Apple thing, I was blown away by it. It's like most people won't even think about it. They'll just go, oh, Apple's going to be, carbon neutral. And they just think it's great. But is it?
Yeah, I think that the devil's in the details on all of these kinds of deals as to whether the carbon emissions are actually being reduced or not. The real atoms. If oil and gas companies are blamed for high prices at the pump, are we going to get blamed for high Bitcoin prices one day?
Well, when we were talking about our energy strategy and when we put out our press release with our August results, there was a lot of pushback on some of these numbers. Now, some of it was just misreported, but I said to somebody that called me, I said, in 10 years when Bitcoin's at, you pick the number, 100,000, 500,000, whatever, that power price spike might not incentivize us to stop mining.
Well,
so then we don't stop mining and we don't support the grid. We're going to be the villains also.
We're going to be the villains. In either case, they will find something. But I think that with the difficulty adjustment, that the difficulty would increase so that that strike price today, it's let's say $90 to $100 per megawatt. And so as the Bitcoin price increases, there's kind of that lag time between the Bitcoin price and hash rate.
Sure.
Which is, let's call it 12 to 18 months.
Right.
Where we can see that strike price go up, and it could go up significantly. I mean, today, let's say we're at $30,000 a Bitcoin. Bitcoin doubles to $60,000. That means the strike price doubles overnight until more hash rate comes online and
brings
raises
it back
difficulty.
down.
Yeah.
But I mean, when last year, or maybe it was 2 years ago, the price caps have kind of changed in ERCOT, but used to be able to get to $5,000 a megawatt hour. Was the price cap? I think now it's 3.
Well, I think it was more than 5,000.
Okay.
I think it was north of 5,000, and now after Uri they brought it down to 5,000.
Oh, to 5,000.
Yeah.
Okay. But at 5,000, if you reverse engineer that into the price of Bitcoin, it's kind of jokingly, but we're the first company to sell Bitcoin for $1 million, right?
Yeah.
I mean, that's how big of a number that is. People don't realize that. So, it's never a dull moment with the public. I mean, that's a big part of my job is educating people on our strategy, the power side, leaning on you guys for the Bitcoin side and educating on that. And we're just going to keep doing it. It's great.
And I've been learning about grid economics from experts in the energy area. And something that I find fascinating about it is how the electricity price can go from $100 a megawatt. Well, first of all, it can go from negative to, let's say, usually like $20 to $50, and then to $100. And then all the natural gas peaker plants turn on. Once you run out of those, then it goes from $100 to $5,000 because demand is so inelastic.
Yep.
And people say, oh, let's pay consumers to curtail instead of paying Bitcoin miners to curtail. But when you actually ask consumers, hey, it's 100 degrees outside. Do you want to turn off your AC for $3?
Yeah, yeah,
Right? Because
yeah.
that's $5,000 per megawatt.
Right,
It's $3 to turn off your AC.
Is that what it works out to?
I don't know the exact numbers, but that's
it's not that much.
No, it's
Yeah.
not, and they're sweating, and so it's kind of unrealistic. But it has to do with the demand elasticity on power, and also that you don't get your bill until a month later. So maybe if we move towards kind of real time pricing, and I saw that Tesla is actually pioneering what's called a virtual power plant. So if you have a Tesla automobile, they'll be able to discharge the battery in your automobile back to the grid at $5,000 a megawatt. And then you get, as a consumer, get compensated.
That's great.
And then it charges back up overnight.
That's great.
Yeah.
I mean, if you can incentivize the consumer, I think it's good. Unfortunately, I think people are lazy in by nature. And so like they're going to get that in the mail and they're going to go, or they're going to get an email about it. Like in California, we get emails about enrolling in these different programs. And the difference between, this program and this program is pennies, right? And so it's like, I'm like, whatever. I'm like, I'm not turning my, my stuff off. I don't want to be restricted. I mean, you can get to that kind of, that futuristic world where they, they put a thermostat on or a meter and they control you, right? I mean, which is, kind of anti-Bitcoin, right?
It is. And I think that it puts the grid operator in a tough position because they've got this demand and they have to meet that demand, that firm demand. And then if we look at Bitcoin miners, like we're super flexible. And so, we can turn off, and economically we have to turn off above a certain strike price. Otherwise our marginal, it's a marginal loss.
Yeah. And I mean, and I think it's important to put in perspective, like there's about, depending on the most updated numbers, there's about 2,500 megawatts of mining in Texas, right? Which would be plus or minus 75 exahash, okay? So let's just think of those numbers. So 2,500 megawatts on a 100,000 megawatt grid, we're 2.5% of the demand, okay? And then 75 exahash out of, 400 right now, is 25% or 30% of the about 20 network, of the network. So the point is that we're still a very small part of the energy grid, but we're becoming a bigger part of the Bitcoin network, which I think is net positive, right? I mean, taking some away from NGOs and nefarious players, right? But the point is that there was at one point over 5,000 megawatts of Bitcoin projects being planned in the grid. The crypto winter that we just went through, although I hate using the word crypto, but I always joke we don't use the C word at Riot. We're a Bitcoin company.
I approve.
They've slowed that all down now, right? Because what happened is people had really pretty presentations saying we're going to grow. And then when the price of Bitcoin collapsed, the capital markets collapsed and they couldn't raise the money to do that. And it really irritated ERCOT because they're not thinking about 5 days or 5 months. They're thinking 5 years, 50 years out, right? Because they're planning the grid. The name of ERCOT is important. It's the Electricity Reliability Council. Their job is to ensure reliability in the grid. That's it. And so they're trying to make these long-term decisions on how to keep that reliable. And if you say, we're going to put 5,000 megawatts of mining here, and then all of a sudden you cancel it, well, then all the plans that they made are, have to be changed. And so they've addressed that by forming a new division called the Large Load Task Force, right?
Yeah, large flexible
load task force, which is another mouthful. And there's all these projects in the queue. And what they've done is they're basically, you can apply for something, but there is a CapEx requirement with that. And there's a timeline to meet that CapEx. And so if you don't meet that CapEx, your application now goes to the bottom of the pile. And so it's slowing down the growth of mining in Texas, which, I think it's probably good to take a breath and make sure that things are going right. For Riot, it's awesome because we're already fully permitted for our next facility. And so I think next year as we go into the halving, if we get the perfect storm of an ETF approval in April and a halving in April, bar the door. Like, I don't know what's going to happen with the price of Bitcoin, but then all these people are going to be running around the world trying to find, energy assets to exploit for mining. And I think in Texas, we're going to be in position A because we're going to be building our, next big facility. We've kind of, we've provided guidance through 2025 to grow our hash rate to 35 exahash. But after that, we still have 4 more buildings to build.
Oh.
So we could technically get to 50 exahash, which is blows my mind from where we were just a couple years ago. And so I think in a commodity cycle, you're always, when it's the worst feeling in your gut to build is when you should build. And then when it feels good is probably when you should be selling and moving into, trying to allocate resources differently.
And that feeling in the gut, I mean, you look at the hash price, right? And I think that's where the pain is. And if we look historically at the hash price in bull markets, it does skyrocket. And so, yeah, we could see people mining with S9s in their garage profitably at some point if things go the way we think they will.
I think 24 is going to be really interesting year for Bitcoin. And I think it's going to be great for Riot because of how we're positioned, and strap in. It's going to be a wild ride. But
I think the part of the negative sentiment and kind of let's say some people have characterized it as a disappointing bull market, the previous one. They had the laser eyes on and they wanted to go to 100K. But, I think part of the reason why we didn't is because where we were in the monetary cycle, right? That tightening.
Yep.
And when you speak with institutional investors, where do they see kind of rates going, and how do they feel about where the Fed is and inflation is?
Yeah, that's actually a really good point. It could be kind of the third leg of the stool in 24. If the Fed continues to tighten the monetary cycle and we actually turn into a recession in 24, then inevitably they got to cut rates, right? So imagine a rate cut, an ETF, and a halving all in the same year, right? Yeah. So I think the macro guys that I talk to, I think most people think we probably have a few more rate hikes coming. Yesterday, the CPI came in hot. It was 3.7 instead of 3.6. I mean, the CPI, I think, is a manufactured number. And so
it's like, despite being manufactured, it's high.
It's still high, right? It doesn't include food and energy, which everybody, it's 25, 30% of your budget, right? Yeah. So how do you not include that? So, the government statistics, I think, sometimes you have to really dig in, and I don't think inflation is tamed by any means. And so that would suggest that they're going to have to hike rates a little bit more. But at some point, that's going to slow things down. I was at a conference, and an economist had a really succinct kind of scenario, or his comparison of what had happened. And he said, during COVID, because we were all trapped at home, our consumption of hard goods got pulled forward. So you put new carpet in, you painted your house, you bought furniture, you bought new computers, things that you would have bought over a 4-year period, you brought into a 1-year period, right? And then we come out of COVID, and what does everybody want to do? They want to travel, and they want to have experiences. So now we're pulling 4 years of concerts and travel and all those experiences today. And that's where you're seeing some inflation. Taylor Swift tickets at $5,000, right?
I read she's causing inflation.
Yeah. And so what I think is happening is you're good, like your manufacturing industries are already kind of in a little bit of a recession because of that pull forward of goods. And then, we're in a bull market for all this consumer stuff. But that's what scares me, because if the consumer pulls back on flying and cruises and eating out, then is the manufacturing side going to come back in quick enough to kind of balance the soft landing scenario? And, I was an econ major, and my favorite macro econ professor, Dr. Randy Parker, had the best, I remember, I was like a freshman when he told this. He said that all these people think the Federal Reserve can thread the needle and have this perfect scenario. And his analogy for the Fed was, the Fed is driving a tractor trailer down the road. And all they can do is step on the gas to make the economy go faster, or they can hit the brake to slow it down, but they don't have a steering wheel, right? And so if you think about it, that's where we're at, is that they're trying to slow down this tractor trailer, but it's hitting these guardrails, right? And you don't know how hard it's going to hit one. Is it going to flip, right? And so I think it's a really good analogy for where we're at in the economy, is that they're trying to slow this tractor trailer down. We'll see how it plays out in 24. But I hadn't thought of the third stool until you kind of brought that up, and the third leg, I mean. Yeah. And if you get quantitative easing, Bitcoin ETF, and the halving, Wow.
Yeah, in terms of the Fed hitting guardrails, I think a big one was SVB and kind of just a wider banking system having all these unrealized losses on their balance sheet from
Yep.
holding treasuries,
Yep.
the risk-free.
Yeah, the risk-free rate's at 5.5% right now, right? So if you don't want to have risk in your portfolio, you can earn 5.5% right now buying the 2-year, right? Or the 10-year might be a little bit lower than that. But yeah, it's funny. It's funny that you mentioned Silicon Valley Bank. So I was at a conference in March. Bitcoin was down on the first day of the conference, and sentiment was down. And then that morning was when it, maybe it was on that Friday, maybe it was on Sunday when it happened, the actual blow up. That Monday, Bitcoin was up, $3,000-$4,000. I'm just strutting around the conference. Everybody wants to talk to you. Like it brought a whole new group of people wanting to know about Bitcoin, because all of a sudden we had to become experts on bank deposits and the FDIC. And I was embarrassed that I didn't know this, but I thought that if you had separate accounts in the same bank, they were each individually insured to $250,000. It's only one time for you. So I could have 4 different accounts. I could have a savings account, a checking account, a CD, and something else. And I could have $250,000 in each one of them, but I'm only protected as an individual up to the $250,000, not the full million.
And that's when people start thinking about Bitcoin's fundamentals, right? Looking beyond just the chart of, oh, I can potentially self-custody this asset. So maybe that's the fourth leg is instability in the banking system, causing people to want to hold their own keys.
Because people all of a sudden realize, like, where can I put my money at? Like, real estate is one of those assets, but it's sticky, and you can't just go buy $1 million worth of real estate in a day, right? You got to go, see the property, do the 30-day inspection and get it tented, all this stuff you got to do when you buy a house, right? You can go buy gold, I guess. You can go buy stocks, very quickly. But I think a lot of people were kind of scratching their head like, what do I do with this money I've got in the bank that I just thought was safe? Like, I don't feel safe anymore. And so I do think that people that were on the fence, we definitely brought a lot of those people, that event, I should say, brought a lot of those people back into the Bitcoin kind of mentality. And maybe that's why Larry Fink, all of a sudden got religion on it, right? I mean, especially, imagine how much money he probably had sitting in banks.
I imagine he was a little nervous going through those weekends, right, where the FDIC's taking things over
and doing it arbitrarily, too.
Right, making up rules as they
go. Oh, you guys, and it was kind of disappointing because I felt like the Bitcoin industry and people that were banking with, they got targeted for no reason. And you had banks that had 5% of their business were related to Bitcoin miners or other people in the industry, and they were targeted. Yeah. And that wasn't the systematic risk that they should be focusing on. And the next one is going to be the commercial real estate. All these apartment buildings and office buildings are going to come up for refinancing, and it's not going to be at 2 or 3%. It's going to be at 6, 7, 8, 9%.
And with different occupancy.
Much different occupancy. Yeah. I was in New York. It feels like it's getting busier, but there's still a lot of, vacant buildings and businesses. And every time I'm in different cities as I travel, I can't believe I see people building more office buildings. Like, that's still kind of crazy. Like downtown Austin, every time I come in, there's some building that just got knocked down and they're building something else. It's unbelievable.
Well, I think there's a lot of people moving from coastal, high cost areas to Austin and driving up. And, I think the commercial real estate, they'll find a way to blame Bitcoin for that because it does seem like whether it's with SVB or, with the grid this past summer, I one day I see a news article saying, hey, these Bitcoin miners are receiving X number of dollars from ERCOT, leave it to your imagination that this is bad. And then the next day I see batteries saved the grid. And no mention of how much the batteries were paid. It's all positive spin there. But these are two essentially equivalent services that are being provided to the grid. But anytime Bitcoin's involved, I think that there's kind of a knee-jerk anti-Bitcoin that then goes and spoils everything else that they're reporting on.
I'm blown away at the amount of publicity that we get and Bitcoin gets relative to the world and the finance world. You know what I mean? and it just feels like the traditional media, we're the punching bag, and it sells what, whatever. I guess you don't sell papers anymore, but it clickbait, right? I mean,
Clickbait, yeah.
and they love it. I mean, and it's I remember experiencing that in the oil and gas industry, and I think they finally, beat them up so badly that they've moved on to,
Yeah.
to
Mission
Bitcoin.
accomplished.
Yeah, mission accomplished. But yeah, it's I get pitched a lot for marketing services at Riot, and I'm like, do you see how much how much we already get? I don't, we love exposure, but we're not struggling to get exposure. We're struggling to make sure that the message is correct. It's scary when you start thinking about the news cycle. We're going into election year in 2024.
Mm-hmm.
There's another thing. I mean, 24 is going to turn out to be one of these years. It's like, you better get your bingo card ready, because there's going to be a lot of things that you haven't anticipated that happen.
Yeah, lots of volatility on the political side, and the ancillary services that is run by ERCOT. We were less than 1% of their budget, and we get front page.
Get 99% of the press,
right?
Yeah. And what and a lot of people don't realize with ERCOT, and even the consumer, is that when you get your power bill, there is a tax, almost like a line item, that you pay to ERCOT. So it's just like when you're, when you buy a ticket from Ticketmaster, and there's that service fee, right? That's ERCOT. They have a service fee that they charge every consumer, including us, for their business. They're funded by that. They're not funded by the taxpayer. They're funded by consumers' electricity consumption. And so, yeah, ERCOT paid us $7.4 million, but over the last couple of years, we've spent millions of dollars to support that organization through those fees. And that's the purpose of that surcharge, is so they can regulate the market. And
in return, everyone has reliable electricity. Power. And to their credit, we did not have any brown or blackouts this summer here in Texas. I think that's astonishing, given the demand growth and the complexity of the grid that's evolved.
And I think most Americans are spoiled, and if they haven't traveled internationally, they don't realize how resilient our grid is. I did a conference in Puerto Rico, and within 3 hours of being in Puerto Rico, I was out to dinner. It was about midnight, and I'm eating, my traditional Puerto Rican meal, and the power just goes out. And it kind of startled me, because I'm not that used to it. And I look around, the restaurant, everybody just keep eating. This is just a normal night in Puerto Rico. And it happened 3 times during dinner. It came back on, it went off. And here in the US, people would be irate, right? Yeah. I mean, they'd be calling their how can this happen? So we're fortunate in the United States that we have the wherewithal for the grid and the redundancy. But I think people take it for granted, and it's not as easy as just flipping a light switch, right? There's a lot that goes on behind it, but yeah, it blew my mind. It was just, and everybody, oh yeah, this happens all the time. It's it's just part of being in Puerto Rico.
Well, it's hard to have demand and supply match up exactly right by fractions of a second.
Yeah,
and very little inventory. I think if we think about inventory, there's batteries. But there's less batteries than there are Bitcoin miners in Texas. And on top of that, these batteries, just like us, they're bid into ancillary services. So they don't just operate on their own. They operate with ERCOT's direction.
Yeah, they're not doing it just to be nice. I mean, it's the old, the Charlie Munger quote that I always love is, show me somebody's, motivation or incentive, and I'll show you the outcome.
Yeah.
And I think that applies on a lot of things that's going on in the grid. And quite honestly, I think it's one of the reasons that he's negative on Bitcoin, because Berkshire's trying to build $10 billion worth of peaker plants in Texas. Yeah. And so who's the biggest competitor to a peaker plant right now? We are, right? Because we're basically a peaker plant. We can ramp up and down in 10, 15 seconds time, but we're giving that power back to the grid, whereas a peaker plant comes on and supplies the power to the grid, but the economic incentives are exactly the same.
Yeah.
So it's fun.
So on the capital markets side, I heard someone suggest that because there's more public miners now, that things are going to be different after this halving than they were after the previous one. Do you think that has any effect on it?
As far as the halving, and
then the adjustments to it afterwards, right? That there's going to be economic changes.
So there's about 20 public miners. I think there'll be less after the halving, unless we have a significant increase in the price of Bitcoin. When we looked at the data, and it's in our corporate deck, we kind of put a peer group out there. We don't name names because it's a little bit of gamemanship, but there's producers that are north of $17,000, $18,000, $20,000 per Bitcoin. So when the halving occurs, you're going to have people that are at $40,000 in costs.
Yep.
So they have a choice, right? They can run at a loss, okay, and then you go to their balance sheet. How much cash do they have? So how many months of burn can they survive? They can turn their machines off, okay, which we've seen that data post-halving. You usually get a decrease in the global network. Again, it depends on the price of Bitcoin, right? I mean, that's the old kind of the joke, right? It always depends on the price of Bitcoin. But there's going to be people that have to shift. And if I always look for like kind of countersigns and bottoms and tops in industries. And in the last day or two, I've talked to more Bitcoin people who are getting out of Bitcoin and going into AI.
Yeah.
And so I think that to me is I want to be more long Bitcoin and more short AI because it's usually that's the peak of the cycle when people give up on something and try to move to the next hot thing. But yeah, as we get into that halving, people are going to really have to pay attention to their costs. And I think post halving, there's going to be a few people that either have to go out of business, maybe they merge, and you try to get 1 + 1 = 3, but it probably doesn't work, right?
Yeah.
The other thing that could happen is if you have a inefficient fleet, but you've got a good infrastructure, then maybe you have to go out and raise money and put in new machines, and then you can lower your costs. But there's going to be a lag effect to that. So I think that first 90 days, you usually see the network come down, and then it kind of comes back up. Is that because of price? Is it because of people swapping new machines for old? Combination of both? We'll see, but it's going to be really interesting. So I think there'll be a few that are out, and there'll be some consolidation, but I don't know that Riot will consolidate. I think we've got Corsicana kind of going. We've got a lot of visibility. We've got a low cost to distribute out there, to grow our hash rate. And until things get really stressed, I don't think that there's attractive assets that pop up for us, at least in the short term.
So yeah, so that organic growth with Corsicana, let's dig into that.
Yeah.
How do you see that fitting into kind of the overall balance sheet and capital strategy for Riot?
Sure. So just a little history. We bought 275 acres in Corsicana, Texas, about an hour south of Dallas. Over a year ago now, right? So it was, in this business, the blocking and tackling that you have to do takes 12, 24 months. And we were buying equipment for this facility over a year ago. We were buying transformers and conduit and all these things that you need that just aren't shelf ready, okay? And we were criticized for it. So, I mean, I held an analyst day, and that was like the number one question. Why are you guys still spending money? Bitcoin's at $16,000. You're crazy. And we said, look, we've been through this cycle. We've been mining since 2017. We've got a strong balance sheet for this reason. We want to be able to make the decisions we want to make versus having to make decisions we don't want to make, right? And so we kept building. And so to date, we've spent a little over $100 million out there. The first phase is for 4 buildings. That CapEx is about $333 million. But what's nice about that is the $133 million of that is building an entire campus that can hold 10 buildings. The actual buildings themselves are about $50 million, but you have to. I use like a home builder as an analogy. If you buy 1,000 acres and you plan to build 1,000 houses, the first year you're putting in bridges and roads and internet and sewer. You're building all that infrastructure so that then every year you can build 100 homes for 10 years, right? If you do it the opposite way, you waste a lot of money. You don't get economies of scale. And a lot of things that were done at Rockdale, which was done kind of piecemeal, right? It was kind of, I always joke, like a little bit of bubble gum and duct tape here and there, right? And then we bought it and kind of accelerated it. They've learned from those kind of trials and errors. And so we've taken a different approach at Corsicana where everything is being put in at first. The first 4 buildings are being built. We've secured miners for the first 2 buildings, which will take us to a little over 20 exahash in the first half of next year. And then in that miner order with MicroBT, we've secured 2 additional options that can add another 15 exahash I think that since we're building 4 buildings, the first option is I don't want to say a no-brainer, but we're not going to leave 2 buildings empty. We're most likely going to exercise that first option at some point. And then so we'll be the back half of next year, that would take us to 28 exahash. And then we would have to build 2 more buildings in order to exercise that third option. So from a CapEx standpoint, the first 2 build or the first phase, if you take that with the 4 buildings at 333 million, you then have another 300-ish million of machines. So we're building, for $600 million, we're getting 15 exahash of computing power. And so that's about $40 million in exahash. That's how I kind of think about deployment. Our market cap right now is, around $2 billion. Our enterprise value is about 1.5 billion. And we have 10 exahash of computing power right now. So if you think about what that means on a valuation basis, the market is valuing our exahash at about 150, sometimes $200 million in exahash. So if we can deploy capital at $40 million in exahash, 45 million in exahash, the market is rewarding us almost a 4x for every dollar we spend. So I don't care what business you're in, that's a pretty nice return on investment if you think about that. Now, those numbers are going to change. If Bitcoin goes down, that multiple shrinks. If Bitcoin goes up, that multiple could expand. But that's kind of the groundwork when we're thinking about deploying capital and where we see the company at. I mean, at $200 million in exahash, when we get to 35 exahash, that would make us a $7 billion company.
Yeah.
Right? So that's pretty awesome. And then after that, we would still have another 15 exahash at Corsicana to get us to 50 exahash, which at that multiple would make us a $10 billion company. That's crazy, right? Like that's what gets me excited. And I've told this to you before, and I think to investors, but my goal as a capital markets guy and as an investor relations guy is I want to be the first Bitcoin company to be in the S&P 500.
Yeah, that would be awesome.
Because that would just be like the crowning achievement, right? And right now, the requirement to be in the S&P 500 is you have to be a $15 billion company. So we're not there yet, but that's not that far down the road, right? I mean, and that's at $25,000, $30,000 Bitcoin, right? So,
If the hash price goes up, are the options for the machines at a fixed price?
Yeah. So one of the things we did with this order was, as Riot being a leader in the industry, we felt like ordering machines from MicroBT for the first time really kind of gave them the stamp of approval. And we were worried that stamp of approval would raise prices of machines because they're going to be like, look, Riot's using them. You guys should be using them. And now they're $25 a terahash instead of 22. So as part of that agreement, we locked in that $22 per terahash on the next 2 orders. And there's a reset clause in there that if they were to go out tomorrow and sell machines for $20 a terahash, we would get that price. So what it does for us from a capital markets perspective is if we know with almost certainty what our CapEx will be for these next 3 orders. And so we can plan that. We have enough Bitcoin and cash actually on the balance sheet now that we could almost get there without external financing. It's a cash and CapEx intensive business. And so we're always looking for ways to expand the balance sheet. Equity has been the preferred way. Just given the volatility, we're very nervous about debt. Debt usually comes with rules. They call them covenants, right? And so we can't predict where Bitcoin's going to be tomorrow, let alone 5 years from now. If that covenant gets close, then you're basically risking the company on that debt. And so I think we're at the point with our size, our liquidity, that we're not going to do something that risks the entire enterprise to lower our cost of capital by a little bit. So that mentality, I think, was started back in 2017 and 2018, and it's still kind of a guiding principle where we need to be conservative. We're building something here that is like game changer. It's a once in a lifetime opportunity, and you're not going to do something that could risk the whole enterprise. But we feel pretty good with Corsicana and kind of that CapEx budget and the cadence that we have for next year. I think if Bitcoin prices go higher, we can accelerate that. If Bitcoin prices stay stagnant, we can drag it out a little bit longer. But having that that optionality is part of our own and operate strategy, right? Which is
Right.
another differentiator is we want to control our own destiny.
Yeah, I think the risk management is so critical in this industry. Both from the risk of the Bitcoin price and then also the risk of the electricity price. And that's where we can talk about the PPA and kind of our approach to mitigating electricity price risk. And we were talking earlier about the grid.
Yep.
But it's not just kind of the daily fluctuations of the electricity price. We also have to think about kind of the baseline where it is from a secular basis.
And like the long-term curve.
Yeah.
Yeah. So like a PPA is a purchase power agreement. And what we basically do is we enter into a contract with the utility provider. So the TXU, who actually makes the electricity, we have a contract. It's called a take or pay contract. So we basically are saying we're going to use 345 megawatts of power. And if we don't use it, we still got to pay you for it. Right. And in order to do that, you have to put up large deposits. So in January, this is a public disclosure, we paid TXU $24 million for our updated hedging, right? So that's a lot of money, right? And so when we get rewarded with power credits and ancillaries, you got to think about the capital that we've outlaid for that.
And then TXU takes that capital and that for not only that capital, but kind of the future revenue, and that allows them to invest in capacity.
Correct. And so TXU can then invest in wind and solar and batteries or whatever that is, more natural gas peaker plants, whatever, what have you. And then the way that PPA operates on our balance sheet, it's called a level 3 derivative. And the way that the GAAP accounting works and the auditors work is that you have to mark to market that contract every quarter. And so you have a 10-year contract and you're taking one point in time and marking it. And so our balance sheet has a power derivative on there that can go up and down by tens of millions of dollars per quarter, which kind of causes a little bit of noise. But on the reality side, on the back end, TXU could call us for a margin call. So like if the price of power goes down, like let's say we go into a recession and we're not manufacturing, we're not building as much, you might have too much power on the grid and then power prices come down. Our mark to market can happen in 48 hours where we have to come up with additional capital. And so that again is another one of our business risks, but also our strategy of keeping a strong balance sheet so that we're in that position again where we can meet our requirements and not have to do something we don't want to do. But I think it's important for people to know that there's no free lunch, right? Like there's risks on both sides, and you have to put that money up and have to have the ability to meet those obligations.
When people compare our PPA to their residential electricity contract, and they compare the rates, they're comparing apples to oranges. And I don't think many residential consumers would want to enter into a 10-year PPA and be getting margin called.
Yeah. No, and like imagine getting a text saying if you don't wire us, $1,000, we're shutting your power off.
Yeah.
Right. And you have to do it then. Right. I mean,
or you have to pay for the electricity even if you don't use it. People would be outraged by that.
I didn't think of that side. Yeah. If you're not using it, I know it is a little bit different in Texas. I mean, in Southern California, when you buy a house, you get a bill in the mail from Southern California Edison. That's it. In Texas, what I'm told is that you have to go to a website and there's hundreds of providers and you have to choose a provider and choose a plan, which I think is good in some ways. But like, again, going back to, we talked before, like people are lazy. How much time are they putting into those thoughts of consumption, right? But I remember asking a lot of people here in this office when some of this was going on, like, are you guys seeing these rates on your bill? And they're like, no, we're not. I mean, there is a cap in some ways for the consumer. It might go up a little bit relative over different months, but I mean, you're a homeowner here in Austin. I mean,
Pedernales Electric Cooperative.
Yeah, I mean, do you see a big jump in your monthly bill? Like, is it much more in the summer than it is in the winter, or is it? I mean, I don't know. I never looked at it.
So I've put solar panels and batteries on the house after Uri because we didn't want the power to go out. We've got 3 young kids.
Yeah.
And to be honest, when I add up so it's a 25-year debt that you're signing up for, and granted, interest rates were lower back then, so that's in our favor. But when I add up our total cost of electricity, adding the solar panels and batteries has increased our cost of electricity.
Oh, wow.
And so we do still get a bill from PEC, even though I thought we would be off the grid.
Oh, wow.
And that's why here at Riot, I'm not the electrical engineer. We've got a lot better. We got Luis, we've got
Yeah.
Kevin,
Yeah.
managing our
Yeah.
electricity rather than Pierre.
And I've gone down the solar rabbit hole in California, and I can't pencil out that it makes sense yet.
No.
Now, I mean, we live in a much milder climate. I probably use, air conditioning 10 or 15 days a year, right? So it's not like I'm running it 24/7. And my monthly power bill is $200 to $300, right?
Yeah.
So it's not like these outrageous ones that you hear from some other people. And so I've done the work. Like I get the salesman that comes to my door, hey, you should sign up for solar. I'm like, okay. And it reminds me of the Groundhog Day scene where the lady asks him about the weather, and he's like, do you really want to talk about the weather? Because I always start talking about energy with these guys, and their eyes glaze over, like, all right, we're going to the next house.
Right. Yeah.
It's like I've forgotten more about energy than you probably know. So yeah, I'm a all above kind of guy. Like I think anything that you can do to strengthen the grid, the U.S. economy, like innovation, it's all great. What I don't like is when the government's picking winners and losers arbitrarily and trying to scare people into doing things. And I think that this energy transition has a lot of holes in it. And I mean, I've been seeing articles about all these dead whales on the East Coast, right? Because they're putting in windmills. Now, I don't understand how putting a windmill in is killing whales. And so I don't know if that's the media, again, using something to attack something else. It might be. There's been talks in California about putting a lot of windmills off the coast. But what's funny is the same people that fought the oil and gas industry for permits are fighting those for permits. And it's like you can't win, right? I mean,
and they're trying to shut down nuclear power plants that already exist.
but they want you to buy an EV.
Right.
And then, then during, we did have like a summer, it wasn't this year, it was last year. This year's been pretty mild because of the El Nino or La Nina phenomenon or whatever. But there was a year ago when it was pretty hot and they were telling people don't charge your cars, right? So it's like,
yeah. I think that there's still innovation needed to make all the math pencil out. And, key part of that is large flexible loads like Bitcoin miners.
Well, and I think the other one is we're basically using the same battery technology that we've had for the last 50 years. I mean, we've gone from lead to lithium, but we're still waiting for that paradigm shift in batteries, right? Like the ability to, and I don't know when it's going to happen. Whoever figures that out will be the richest man in the world because battery is huge. I know, Elon Musk is doing battery stuff, but he's really still using the same technologies that, and there's all these people who are trying to do it, but there hasn't been a real shift in that technology.
One of the constants throughout my life has been the AA battery. It's the same thing that it was.
I had my yellow Sony Walkman, right, in the 80s, and I still use it for my remote on my TV, right? So yeah, I mean, it hasn't changed.
Yeah, and when we look at the cost curve, they point to the fact that lithium batteries have come down in cost, but over the past few years, it seems to have reached diminishing marginal returns, and so now costs are flat or slightly increasing because of inflation, because of lots of in grid scale batteries getting deployed. That drives up costs.
And also that there's still raw materials that have to go in those batteries, and those raw materials are scarce because you can't permit for things. I mean, there was a big lithium mine in Nevada that took years. They're still not producing lithium. It took them years just to get the permits to start exploring. And you got, environmentalists driving to protest in their EVs.
And refine lithium, you have to have a lot of electricity.
Yeah.
So where are you getting the electricity from?
Yeah, it's a wild world we live in. And I mean, I think some of my cynicism is as I'm getting older, but some people are like, no, it is getting crazier. So 24, strap in, man. It's going to be great.
All right. Well, Phil, this has been great catching up.
Yeah.
Thanks for dropping by the studio.
Yeah, thanks for having me. This is awesome. Do it again.
Yeah, absolutely.
All right. Thanks.
Thanks all for joining us. Let us know if you have questions, questions for me, questions for Phil. Always happy to discuss all things Bitcoin and energy, and we'll see you on the next episode.